Okay, welcome everybody to another episode of MoreTalk, which is your weekly rendezvous of mortgage and real estate with Mike and Michael. We have some special guests today that we're happy about. We actually have three guests that will be participating. We do these live every week. It's a practice of consistency. This is now our 21st straight week. We're calling this now season 2. We do have some guests. We're very proud of it. And what we'll do is we'll welcome callers. So that means you guys can raise your hand. We'll bring you up right around the 235, 240 mark. And this is every Thursday, 2 p.m. live Eastern Time, 11 a.m. Pacific. And then it's always recorded and put on our YouTube station. And that drops on Sundays. You can just look up More Talk with Michael Kelleher, Michael Zhao. If you give it a like and subscribe. If you're listening to this, please give it a like and subscribe and help us build our audience. We have some special guests today. We have Greg Harris, who will be talking about leads, how to work with them, and how to get access to them. And we also have Christine Beckwith, who will give a bigger introduction to both people, but who is a coach, who is a leader, who is a mentor, and who has originated herself and is just coming off a retreat that I really want to get into. And then we have another guest that will be coming in that does a lot of recruitment and really has just been in the industry for about 30 years and put a great article online, or Larry Gunnan talking about what was offered 20 years ago and what's offered today, and just going to get his look. And we're going to bring it all. So we've been talking about cost and getting your costs under control. And now we had some great news out of the FOMC. And so this one's going to be optimism. And how do you plan 2024 with this news coming out in 2023? And who better than my co-host, who's a specialist in capital markets, to really kick off the show and tell us, Michael, what could we take out of that meeting? And then your take, obviously, on optimism going forward. What did people think coming in, and what do they think now?
Well, as the famous Prince song says, this is what it sounds like when doves fly. And it's really super exciting only because, we get a chance to actually hear Chairman Powell talk about, hey, you know what? We're not really considering raising rates anymore. In fact, what we're going to be doing is the consideration of lowering rates. Those who don't know, those who are hawkish want to see higher interest rates, and those who are dovish want to see lower interest rates. And that's why I said this is what it sounds like when doves fly, much to the happiness of originators nationwide. And I think it's super exciting because prior to that meeting, there was talk by various economists that were saying, hey, we're going to see 6 hikes. I even saw that people were talking about 8 hikes. And I thought, how crazy is that? Not on LinkedIn, but in private channels, I was thinking that there's going to be 2. And now more of the consensus is going to be 3. But the real question is it going to be when they're going to be lowering, or how many times they're going to be lowering. The real question is we've seen Wall Street react in very quick fashion, just as quick as rates went up, as we're seeing a buy-in into interest rates. The real talk on the street when it comes to mortgage-backed securities really is going to be when, for this demand in higher interest rates and this potential refinance boom that's going to be coming, and this potential rush for all the buyers that are on the sideline, there is going to be more demand when it comes to mortgages. And if you're an originator, or if you are an IMB, an independent mortgage banker, one of the questions you need to be asking yourself, hey, am I going to have to deal with a very similar circumstance in 2020 during the refinance boom with early payoffs? I think that's got to be on the mind of leaders. That's got to be on the mind of capital markets, and maybe not so much to the originator right now, not until it begins to hit their contracts and their pocketbooks. So as we begin to really plan on what we're going to be doing, I don't think it's going to be the question of when the rates are going to be going down. We've already seen Wall Street begin with the 10-year Treasury as well as mortgage-backed securities. The real question is, how do you plan for early payoffs? How do you plan for fulfillment in processing, capital markets, sales assistance? What are you doing to generate more leads so you don't have this up and down motion? What you have is a gradual up motion. I'm real happy that we're going to have a chance to talk to Christine today, because she's really, in reading an article that she wrote recently, we're going to be able to ask her what is potentially, if she's willing to share some secrets a little bit, maybe open the kimono on some of her coaching. We're going to be able to really find out how is she coaching and how can people capitalize with some of her advice. And then when we get to Greg Harris and some of the lead generation that he's doing in Consumer Direct, what is he doing to also generate more business? And with the companies or the people that he's going to be working with, how is he going to be working with fulfillment? So, Michael, instead of getting into an economic show, let's kick off the show right now. What do you have for us?
Yeah, I have some questions for you, though, because people do want to hear economics. I mean, this is big news, and you're very talented at this. So I think, obviously, rates are going to go down, but a big issue for the IMBs was what they were referring to as the yield curve. So the 2-year Treasury versus the 10-year Treasury, preventing, or I think we talked about it when I came back from the MBA annual, somebody at a large top 10 showed me on a coupon, that the best coupon out there was to be able to offer 7.99%, and Chase was paying just over a point. So his point, I think 1.3. So his point was like, where do you want the margin to come from? The borrowers have to get used to paying points. Does this just make rates better, or does this give an opportunity where the owners now have enough to cover closing costs or be able to have more margin like the old days?
Michael, that's a really interesting question. And I'll answer that carefully because it really depends. Earlier, about maybe 2-3 months ago, just after Western Secondary, there was talks about how long of a landing pad and how long of a ramp is there going to be for each independent mortgage banker when it comes to how long can they survive the bleeding. And right now, the question it should be actually very similar. Even though we're going to see more originations with lower rates, we're actually going to see some refinances. It really comes down to how are you going to manage potentially, at least in the last 3 months, the loans that are newly originated, how are you going to manage the refinances that go through there with early payoffs? And are you going to attempt to put more money into the kitty as an independent business owner? And are you going to stick it to the originator / the borrower? How are you going to be managing your finances as a business owner, as a mortgage company leader? So there isn't one answer, one size fits all when it comes to that, Michael, which is why in this particular show that we have today, it's going to be critical as we begin to navigate what exactly is going on and how are we going to be fiscally smart as a business owner. In other words, the originators are, it's like who let the dogs out, and they're going to be out there. They're already, as of yesterday, advertising on social media that lower rates are coming and you better start buying. I mean, that dog is hunting right now. And so if you're the business owner, you really need to be asking yourself, do you want to take more of a profit to keep it in-house? Do you want to distribute it to the originators? And how much do you need to save, not only to staff up, because there may be signing bonuses if it gets to that point where Wall Street goes a little gaga and crazy over the buying of securities, and if you're going to buy the market, then how much are you going to be saving? I don't know if this is a matter of capital markets as much as it is just a business question of how are you managing your finances in your business as a business owner, and how are you working with your accounting department, your taxes, and your savings to prepare not only for 2020 gains, but making up for 2024 gains, but 2023 losses and 2022 losses. And so
just look forward. Just look forward. Now, that is a good possible segue. Larry, I hear you're in the audience. If you want to raise your hand, you click your face, your picture there in the top right corner, and you'll be able to ask to speak. You had actually posted about how the world's changing with signing bonuses, being careful of clawbacks, how you started, with a salary and a car, and nowadays it's 100% commission and maybe some 401k. We'd love to have you up, Larry, but some computers and some things are not always compatible. So while you're trying to get up, and again, you got to click your face and invite yourself to speak, and then we say yes. And that's for anybody at the 2:35 mark that wants to come up, say something real quick, and let us talk about it. We would love that. A lot of loan officers actually haven't looked at the rate table or the rate sheet, or now they're in all of these new pricing engines, so they don't get the old school rate sheets in the table format they're used to. And they're coming up and they're saying, and this is something that's been old, but irrelevant in the rate market. They're saying, wait a minute, what are all these LLPA hits? Over 80%, 1.5 points now? When did that happen? And that happened during a rate raising environment where really it didn't affect them because it didn't affect purchases. And so now they thought they were ready to go refinance this group of individuals. And turns out, Michael, and I'll let you comment on this real quick, and then we can segue into Larry. Turns out, they're not in the money like they thought. They got to wait for the rates to go down a little bit more. And that's why I'm sure Christine's going to talk. Some people have programs of like target rates, get people ready. So when it comes, you're not then spend another 2 weeks going back and forth. But it's funny, those G fees and LLPAs come back in, Michael. Always good to know your products and your rate sheets, right? When things were slow.
Yeah, got to know what the pricing is going to be like, and really, if you're a leader, to educate your teams and your sales staff on how pricing is going to be affected from this time going on. And I think it's really interesting because this is going to be a chance one more time for retail to come ahead versus the broker. It was really easy as rates were going up to go be a broker because you were fighting for pricing. I think it's a really great opportunity for retail originators or retail shops to go after those who were brokering to take advantage of the current market and environment situation. And so with that, Larry, great to see you. Thanks for joining us today.
And a quick background on Larry. Larry's been around for at least 30 years, and he has worked for many or a handful of the top lenders, and he's gone through many different models, and he's had 5, 10, 15, 20, 100, 200 loan officers under him, or maybe I exaggerate a little bit, he put out an interesting post. I already talked about it earlier in the show, just how the landscape has changed on recruiting loan officers, but has it really, Larry? And what do you think changed in the last week where people were sort of not sure and now they're overly optimistic over 1 week of news? What are you seeing out there, and what should loan officers, I talked to you about this, more like branch managers and regional managers, what should they be looking at as far as staying or going?
Yeah, thank you. Yeah, you're right. In my career, I've had as many as 500 loan officers at one time working with me. And so in the past several months, I've been doing some freelance recruiting for people. And something that kind of popped out during all my conversations with trying to place the people is, unless you're a regional or a branch manager that can bring somebody with you, you're not going to get a job. It's pretty, every company I talk to, this person, even though they're kind of a proven product, it's, well, who are they bringing and how much money, how much volume are they going to bring with them? And so it kind of dawned on me after several conversations, because sometimes I'm kind of slow, on the uptake. It kind of dawned on me, well, where's the investment? I mean, and I think back to the first big company I went with which was Countrywide back in '92. They hired me. I brought no one with me. There were no branches in Alabama, Mississippi, Louisiana, Arkansas, or the Panhandle of Florida. And so I opened up that region. It took me like 6 months, had 9 branches up and running, and after that time I started making some profit. And then the same thing happened to me again several years later. In '09, I went with Prime Lending. I did basically the same thing. I brought no one with me. They hired me on knowing, what I've been able to accomplish in the past. And so what you've done in the past really doesn't count today unless you're bringing volume. So basically, the people today are bringing their own paychecks with them. And to me, that just sounds a little, I'm talking to these companies and they're telling me, yeah, we got all this money, we don't owe anybody. And I'm like, well, then where's the money? So they're not putting it into people. And some of them are paying, they're paying big guarantees and sign-on bonuses. But then now we got several companies clawing those back. So it's kind of like, so do the LOs control the interest rates? And do we control, the market? So it's, anyway,
those are great questions. You had talked to me about people versus numbers, and Michael and I, and just the kind of clients I've had, obviously focusing on the numbers and the money ball aspect is important. But I think you even see it in baseball. You can't take out all of the glue guys. And I think that's what we naturally think of when we think of people, the glue guys. But I think what you're saying is getting back to the people is around the training. And we can't forget that in this world of working from home, not being remote, showing up on a Zoom, half paying attention, there has to be, I think, better training, right? Or hiring the right people that can train and coach the right people. Maybe that, I get what you're saying, people are numbers. Can you explain it a little better where we don't feel like, it's an 80-20 rule and 20% of the people are carrying numbers wise 80%. How do you find out in that 80% which of the people you want to keep and which ones are just really bringing everything down?
Yeah, well, it is. I mean, of course, if you're in the mortgage business, you're in the numbers game, but people to me are more important. People, I mean, I know several people that were in the business that were, like I say, non-producing branch managers or regionals who have built a pretty strong region and doing quite well, and then they're let go. And that is a trend. And that person now, of course, and then the company comes back to the branch managers and say, okay, we were paying this regional X amount of dollars. We're going to split that up amongst all you guys as long as you'll sign a 2-year contract. To me, that just doesn't sound right. I'm sorry. I mean, so now this guy who had built this region or lady are out of a job, and the people are sitting tight because they've received all this money. So that to me is a problem, and it kind of shows the greed, I think, in a lot of ways, that it's all about the dollar, and it's the people are kind of expendable. And I have a problem with that. And I'm hoping that what will happen was there's a lot of new companies coming into business. They say they have a lot of money. We'll see, but are they going to invest it? Are they going to go and take a basic invest money and take a risk or hire somebody to see if they can build it and then build a program or build up a region or a branch or whatever, they may be hired to do. So I don't know if that's answering your question, but that was kind of just my, I don't really have the answer because I'm not in control. I don't run the companies, and I can't, I know my conversations I've had with the hiring people, and it's all about who are they bringing, how much they're going to volume, and if they bring this much, I will pay them this much. So it's, like I said at the beginning, these people are bringing their own paycheck with them. It doesn't seem like the company's putting that much investment in. I mean, most of the companies nowadays, too, they're so similar. You've got different models, we have more models on the...
Yeah, because that's an important piece here, Larry, and we appreciate you coming on here. And so with Christine coming on next, who coaches at the loan officer level, but also at the CEO level of, 500, 700 loan officer shops, or 100. I mean, she could talk about what she does, and we'll give her a great introduction. But before we segue over to you, I think this is so important to the show, because what she's going to be talking about is you and the people you bring and the hundreds of people you bring. And I think sometimes I'm up in Boston and Michael's house over in San Diego, and these national lenders have to recruit across the country. And not just the people and the way of life is different in Alabama where you're from, but also the amount of listings within your counties are different, right? Because listings and inventory is still going to be a big driver, rates or not, of next year. And you could have the best producer in the world. They can't create inventory, or they'd be a real estate agent. So can you just explain, as people are looking, maybe the top 2 or 3 different models that a branch are looking at, and with those models, like what they're expecting out of, out of coaching? Are they trying to do it all themselves, or are certain models looking for more help from mentors or coaches like Christine, or leaders, we'll call them, maybe they're internal leaders?
Are you asking me or Larry?
I'm asking Larry to segue over to you.
You're asking Christine.
No, I'm asking you, Larry. What do you see in the loan officers are feeling there? The ones that want help. What kind of models are they looking at, and what kind of help are they looking for?
Well, you've got your basic, independent mortgage banker that's a pure retail, and then you've got other, you've got kind of 2 kind of company models that are bank affiliated. You've got your huge lender, bank like Wells Fargo, who has a mortgage company, but then you have your other bank companies like, say, like Prime Lending, or some other companies that have a bank that's kind of in the mortgage company. Those models, seem to be that model seems to be a little more aggressive. They don't jump in and out of the market like the larger commercial banks do. The other basic model that I'm seeing a lot of interest in today is the broker model. Now on the broker side, there's gotten to be a hybrid broker model. So it's a little bit of brokering tied in with maybe a little bit more support, a little bit of more help with the operation end of it. And that's where I'm seeing a lot of people kind of looking at in a deeper way than they ever have. And so I think there's going to be some adjustment there. I'm not sure. Like I say, I'm just kind of following the leader here on what's going on with the people I'm talking to. But the key thing, is making sure that the people, their book of business matches the company with the model that they're going to, so they can be both company and individual can be successful.
That was perfect, Larry, and you really set the stage well. Our next guest is Christine Beckwith, who I have the luxury of running into quite a bit out there in the conference scene. She was at the MBA annual. She's always willing to sign one of her books. She is a bestseller. She has 2020 vision for success coaching. She just had a unique, and we know I love unique offerings here in the industry. 12 leaders went out to a quiet place, I believe up here in New England, from what I could tell after. And Jason Frazier, Lauren Brando were some of them. But she was able to sit down and they were able to talk. And I don't know if they're going to be able to talk about what they were saying, but she's fresh off of a lot of ideas. She is a big deal, and she's doing a new speaker series called The Big Deal. So without any further ado, we'd love to introduce you to the show, Christine Beckwith. This is your second time calling in, and you were a star the first time. So thank you for coming on. Welcome.
Awesome. Can you guys hear me okay?
Yes, definitely can hear you okay. Thank you for being here.
Absolutely. Loving the discussion so far, wanting to jump in through the whole thing, sitting on my hands over here. I'm going to let you lead the discussion. Thank you. We did just come off an amazing retreat. We've been doing retreats for about a year now. These ones that we're doing that you just saw are more or less invite. It's 12 people. It's way upper echelon people, top producing. Like, to give you an idea, the originators that were there are over 100 million a year. We'll do other types of retreats, but the discussion's different at that level. Big time brokers, big time retail lenders, CEOs. And the idea is that not only is the discussion more integral and more strategic, but it also lends a lot to what I'm then able to bring back and share within the consulting firm. But what do you want me to talk about? Because you guys talked about economics, which I would love to talk about. You talked about, lots of things, to the models,
Well,
where do you want me to go?
Well, Christine, super exciting. I love that you named your company 2020 Vision for Success Coaching, because it's the article that you wrote and published on LinkedIn last year in December of 2022. The title of it is "An Industry Servant to the Rate: Time to Move to the Offense." And if you were able to actually look through the increase in interest rates, if you were a leader in the industry and you read that article and you're like, okay, that makes sense. How appropriate, actually, Christine, is it that article is even appropriate even now?
Mm-hmm.
And if a leader read your article last year, contacted you and said, hey, this is what we need to be looking at these things, not just as an originator, but also as a leader of a mortgage, whether you're a mortgage broker or a mortgage banker, by the way, the article is appropriate for both. So my question to you, Christine, regarding that is that how can we as leaders in the industry right now prepare sales staff? I'm talking about leadership. I'm not talking about sales.
Mm-hmm.
How can we as leaders really look forward? I touched very briefly about the economics of the losses that we took over the last year and a half. And so what are you coaching people on as far as leadership is concerned in the economics of leading people into more sales on the sales side, and then on the operations side, how are you coaching them so that they're not overstressed? It was already overstressed over people potentially maybe losing jobs, and now we're going to be looking at maybe hiring as the refinances and the rates begin to drop. Refinances increase and rates begin to drop. So if you don't mind, if we open the kimono a little bit on the way that you're coaching, how are you leading leaders so that they can really implement more strategies for economic savings and economic profit at the same time?
Yeah. So I'm going to tell you the problems are exactly the same as they've been since December of 2021. The pockets of loan originations and the capital positions of companies across the nation have obviously dwindled because the same problem has lasted longer than maybe some anticipated. And the pain is growing, but the effects of the lower interest rate are proving to be the same problem that I wrote about in that article. My leadership advice is, this is not a time for soft leadership. And what I mean by that is, as a salesperson, as a sales veteran of executive leadership, I spent 24 years leading sales forces that were greater than 700 originators, 1,250 with H&R Block. And when you get into a market like this, you have to level up to a point where you are out there kind of like in wartime and you are leading people to the solutions. 4 years of loan originators servicing rate sheets is a nightmare, because essentially everybody became excellent service providers. Some of them, showed the speed and ability to do, great quantities of volume. And some obviously couldn't keep up with the volume, and we had the tsunami of sales. But it conditioned our loan originators across the nation to be a servant to the rate, which is what my article states. And as a result, it is an enormous pivot. It was an enormous pivot for us to start coaching people in December of 2021 when they were still looking in the rearview mirror, hoping for a better interest rate. And they stayed there, by the way. Loan officers literally sat in the cars of their sales and looked in the rearview mirror for a solid 6 or 7 months before it sunk in that they needed to turn around and start driving in a different direction. And so, our coaching is pretty straightforward. I don't mind sharing some of the tactics. Michael, alluded to maybe I would give some golden nuggets. The article speaks to a certain way to approach the cash out refi, a certain way to approach the purchase side. I'm going to start by telling you I've spent the whole year teaching economics. By and large, and I don't want to insult the loan originator, the economics is not understood. The market of 07 and 08 has similar effects to this. The volume is down. Obviously, it hurts our industry when the rate comes up. But besides having effects of that stuff, it's a completely different market. And back then, if you needed ingredients to bake a mortgage cake, you didn't have it. Houses were upside down. The demand was low. Deficiency rose to like incredible heights. You had loan modification. You had short sale. Today, we have an inventory issue with high demand. Value is there. We have the ingredients to bake the cake, but the chef, the loan officer, has been baking a different cake for so many years. It's hard for them to make this pivot. So we've been training thousands of originators with 2020 Vision coaching, and we're starting with economics. You need to know what you're talking about. The consumer also, and I'll just spend a couple minutes here. Our consumers are also conditioned to ask very low level, this is not to insult the American homeowner, but very low level questions like, am I going to pay points? Is this lowering my rate? I want to pay my principal down. I want to pay my mortgage off. All of those things are great, but they're driven by generations past when we wanted to pay our farms off and not leave mortgages. There were two types of guys in the 40s, 50s, and 60s, those that had no mortgage and those that had mortgages. We learned wealth strategy has nothing to do whether you have a mortgage or not. It has to do with what your payment is. Payment is indicated by term and obviously interest rate. And so if you understand wealth is created by revolving liquidity in people's hands, and they want to have the lowest possible rate. And when insurance was born and we had the ability to overcome the major objection for that generation, our great grandparents telling us to pay our principal mortgages down and to pay more money and to take lower terms, which is all anti-wealth strategies, by the way. That is bad advice that we've been being given for 50 years. It reduces our tax position. It takes and moves us to a different place. So we're fighting the tide between consumers understanding when it's time to take a higher interest rate because it makes fiduciary sense in their home mortgage portfolio. If we were mortgage experts and we were economically understanding of past markets and current markets, the differences, homeowners pain point? How much cash have they reduced in the last 3 years? Where is that low interest rate mortgage falling right now? Is it at year 1, 2, 3, 4? Where are we at in this cycle? Because 32 to 36 months is about the average length that Americans hold their mortgages in the last 20 years. If that holds true, they're in the worst cash position, the highest debt position, which the US government stats are saying is true. And if that's true, not only do we have the perfect ingredients to bake the cash out refinance cake, why aren't we connecting the dots as an industry? And why are we not able to raise our hand and say outwardly and confidently, I want to have a conversation about raising your interest rate. Give me a call. It could save you thousands of dollars in interest that you would pay over the long term. Loan officers have to pull their calculators out and sit and play out those high interest rate credit cards if they did not put those high interest rate credit cards into their mortgage. They have to play out what happens when the car loan goes over. And I already know that people are going to say, no, don't put your car loan over there. I'll give you a fifth grade math equation. If you have $200,000 mortgage and a $50,000 car loan, you have $250,000 debt. One is being paid on a mortgage rate, one's being paid on a car rate. Your car term's whatever, 5, 6, 7 years. Everybody, grandpa says, don't put your car loan with your mortgage. Why? Because you're going to raise your principal balance. Well, you're not raising your debt position. It's still $250 if you put them together, but you're lowering the car interest rate. And by the way, if you refi that in 3 to 4 years, you've lowered the term of the car loan. Who cares what the principal balance is? We're talking about liquidity, wealth, and all those things. So I get excited when I talk about this because I lived through 07, 08. I shut down H&R Block Mortgage. I was at the boardroom table, put myself out of job after 12 years. I watched everybody scurry to find new jobs. We are not there. I'm not saying the pain isn't real for CEOs that are losing tens of millions of dollars and going through capital right now to keep afloat. I'm saying your problem is your front line. Loan originators need to learn how to sell this market. And if you don't roll up your sleeves and you work it, I don't care what your model is, retail, broker, the loan originators need to learn now. And you know what is going to stop us from doing that? Rates going down. Rates going down is going to hurt our ability to train this national sales force into how to be good mortgage loan officers.
Preach it, Christine. That's pretty awesome that you said that. And last time we talked, we said this feels more like 1998 than 2008. And I really appreciate that you pulpit.
Yeah, 98
to it too. I was at a Massachusetts Mortgage Bankers Association, and I've been doing work with Silk Title, who's a huge impact on the title industry for these refinance companies or places where the consumer direct call it out. It's just so obvious as I call into IMBs, and they are, we barely have any refinances to even talk title. We maybe do 10 and we do 400 purchases. I think we got so far over to that being the vernacular that we got away from like the type of loan officer that's refinance and the type of loan officer that is purchase. I've realized COVID made them so much further apart than ever before. The purchase loan officer is a schmoozer in the sense that they, and not in a bad way, but they maybe coach or they sponsor a little league team or they attend BNI locally. They are at the ribbon cuttings, right? And the cash out refinance person, if you're not interested, is on to the next. And when you pick up, they're going to walk you through that debt scenario. So I was at this event and I was explaining to a loan officer, and he's like, I would never tell anybody. Like, yeah, you can't tell them to get out of today's mortgage. It's at 3%.
That guy's I would not even waste my time. If someone was standing in front of me right now, that's my first question when we're coaching here. And I don't do a lot of coaching, by the way, running this company. I have 24 executive coaches and 60 guest host coaches. Obviously we meet, we talk about economics. I make sure everybody knows what they're talking about and what they're going to be sharing in our live and digital classrooms. But at the end of the day, I do the weekly sales meeting. So we bring in economics into that meeting and that sort of thing. So they're always hearing from me in terms of what I think they should focus on. Yes, there are loan officers here that do not believe it. And by the way, this is why their marketing is falling down. I see weak marketing by weak loan officers that do not understand how to sell this market. I see strong marketing from strong loan officers that do know how to sell, that I believe that I would call if I was a consumer. And so, of course, we're teaching the marketing difference. One loan officer is trying to avoid the rate conversation. Another one is leaning into it and getting into those objections that the homeowner's bringing to the table. Listen, I got the 2s and the 3s as well. I love those rates. I would love to hold on to those interest rates. But if I was in a position where my cash was dwindling and my debt was rising, I would give that rate up to get myself into a better position, obviously, and then refi in a future situation. There's some homeowners you're never going to change the mind of, but we've got to find out who has the pain out there. And if you resist that, you're going to avoid getting volume. And I just think there's so much deer in the headlight effects. It's killing companies. I'll also say this for the purchase side. Stop cold calling realtors. Nobody wants to hear from you if you haven't called them in the last 5 years. FYI, I'll start there. Secondly, if you're going to have a conversation with a realtor, maybe what you should do is attract the realtors to you. Maybe you should start marketing and digital strategies where you're saying to your database, hey, were you thinking of selling your home in the last 5 years before COVID hit? But then the house became a shelter for you, your kids' school, your home, your home business. Do you want to talk about selling your home? A lot of these loan officers will take a referral when they occasionally get it. They won't look for them either, but when they occasionally get the friend or the family member that wants to sell, and they hand them right away to Susie Realtor. And in all due respect to realtors who I love and are on our platform, they're not always the best or most convincing to get over those homeowners' objections that don't want to buy high because they're selling high. There again, you've got a 5th grade math problem. If you've got an orange that is worth $2 and you want to buy an apple, the orange being your existing house, the apple being the new house, and you look at it and that apple used to be $1 and now it's $2, and you don't want to buy that apple for $2 because maybe you think that apple is overpriced. Maybe you worry you're going to buy it and the value is going to go down. Even though statistically we have seen homes ascend in value. Have we seen singular homes have bubbles where they were overpriced in Southern California? Yes. In fact, the U.S. government reported 11% of homes in 2022 were overpriced. Will those individual homes lose their value? They might. Those individual homes that were overpriced might. But those reports that I read across the board stated that no one market, county, town, state, had a degradation of value. So with this in mind, we aren't in a bubble, and that's proving itself out right now. So if the homeowner's thoughts are, I don't want to buy that inflated apple price, so what's the alternative? Let's go the other way. They're going to wait for their orange, their own home, they think, go down, rates to go down, the value to drop. When that happens and their orange now is only worth $1.50, they're putting less money down on the future house that they're buying. They're changing their DTI. They're changing their LTV. They're changing their risk position. They're probably paying a higher interest rate. And so let me tell you, like, if we can't sit in these inept objection conversations with homeowners that don't understand this, we're not going to overcome that. If we don't go out and mine as loan originators for people that want to sell, and as a third party to the transaction, give them good financial advice and get these people selling, then hand that brand to a realtor that maybe we want to work with, or one of our partners that we want to show value to, and get that home seller's purchase. What are we waiting for? The realtors to hand us the purchases if they're getting those listings from somewhere else? Like, these strategies are not sneaky, slippery, scripty things. This is the basic economics of our real estate market right now. And it is eluding corporations and loan originators. I sound mad when I'm talking because I'm so passionate that we're missing the deer, and we are literally sitting in a field able to look around and see all these opportunities. My guys that are with me, I will say, as I finish, they are selling. We have refis. We measure what they're doing. My guys that are coaching here were struggling in the beginning of 22, and they're closing 6-8 refis a month. My guys were struggling in the beginning of 22 doing purchases. They're finding 4, 5, 6 listings for sale to hand to their realtors doing these strategies, and they're getting the buy side on the other side, and everybody's happy in their real estate home. These are small pivots that need to be made.
We are in a position where we do try to say things are different, and I agree with you totally on the purchase side, but to keep the mindset on the refinance, because I just want to land that plane. I'll let Michael ask a question. I think it's important to know like 65 to 80% of millennials regret buying their home, and that's a time where their equity's gone up like 20, 30%. Can you imagine if they would, how much more they would regret? I think it's just the people that grew up with phones are different. Now, I'm an older millennial, which means I didn't get my smartphone till like right at the end of college, actually probably after college. Earlier millennials mean they might have even had the smartphone in high school, and then Gen Z. But these are important demographics, we've always said, because they're just so big that you could almost, the great analogy is the most dangerous dog, I believe, is the beagle, or like the most likely to be bit. But that's just because that's what there are the most of. So therefore, it's the most likely. Same thing here. The most purchases in the future at some point when the dam breaks, millennials, Gen Z, I think they regret, and this is more statement than a question. So I think they regret the houses just because like Instagram's always changing. No one's ever showing themselves on their knees grouting a tile. It's the after finish tile, and it's always changing as they go through. And so this goes with your point, though, Christina. 70% of millennials have more than $100,000 of non-mortgage debt right now. And if they're not your grandfathers on the farm that want to retire in that same farm, and they don't know what they want in life, but they certainly don't want to be tied down to anything, then maybe using this as a vehicle versus a way to keep yourself from spending money. Maybe they're smart enough. Maybe they can be financial advised enough, whatever that is. But to just automatically, like that loan officer I met at the holiday party, to assume that anytime you pay off their credit card, they're going to immediately rack it back up. That's just such a loan officer mentality that they're going to rack it up no matter, or find a way to give the people at Discover and Visa the interest no matter what you do. So you might as well put them in the best position today to succeed tomorrow. So I just wanted to give some of those stats there. Michael, do you have a question?
Yeah, Christine, you touched so many things I also feel passionate about. And the disease that's been plaguing our industry for the last 30 years has been selling rate instead of value.
Yeah. Yep.
And I think that, one of the things that I often tell my clients, or I had until I switched into trading paper and talking to actual larger family offices, was, hey, I don't really care about what you spend. And that's what I'm thinking in the back of my head. What I really care about is what do you get a chance to keep? Because if we actually had the mindset of what do you keep versus what you spend, we would be less focused on interest rate. We would be less focused on what does this cost for $50 or $75, tax service fee, points, and because everybody's got a different tax bracket. So, and those who are the leaders at Mortgage Coach or MBS Highway or the leadership have always been talking about what is it that you keep versus what is it that you spend. And I think if we had more of a confidence-based mindset in the origination space, in the retail origination space, versus a fear-based mindset. The fear-based is that we're going to lose this lead, we're going to lose this buyer, we're going to lose this refinance, instead of saying, hey, this is the value that we're bringing in after-tax benefits. And as Michael just alluded to, this next generation, they want so much immediate gratification that they're not looking at it as, hey, I'm investing for a 7 to 10 year ownership or a 4 year to 10 year ownership with all the tax benefits that come with it. And yes, there are all the memories that you get to buy if you're going to be selling emotions versus selling money, and all the benefits that you get in after tax and the gains and so on and so on. Even if you made no money on capital gains, you still got all the after tax benefits. And so what is the charge, not only from a retail standpoint on the standpoint, so how do you think we can change in the retail platform on what is it that you keep versus what is it that you spend? And is that something that could start from the leadership level as well? So that you can bring that from leadership at the IMB or the broker down to the trenches of retail originators. And how do you bring that down to that level? How do you coach people? Maybe you can't get into how do you coach them, but how do you think we could bring that down to that level?
Yeah, I mean, I had the honor of opening the IMB webinar for 2023. Joe Penabianco is the chair, and as you know, I was Joe's senior vice president of sales for 12 years. I, started with them many, many years ago, and helped build the national sales force and everything that also flowed under the hood with recruiting, marketing, and whatnot. And the conversation was, I understand you're going through a storm. When you're going through a storm like this, the retail lenders obviously are battling other models, and with rate being the focus and the overhead the retail shops are carrying, it depends on how big your Carnival Cruise Line is in this storm, because you got to get small fast. So you're throwing a lot of things overboard. And I think, all of these companies have done prudent work to get themselves into the lowest possible position of loss. But it's distracting. And if you're relying on last year's quarterbacks to run your sales forces while you're trying to, right the ships, and they're, yelling at all the loan officers to do more of what's not working or not giving you return. Well, now you're paying a lot of money to a lot of people. There's the whole conundrum of, the grass is greener, so you're trying to retain. I've heard of large retention bonuses being paid this year to keep branches. So now, there's extortion going on underneath the hoods of these organizations to keep people in place. It's like not for the faint of heart. I get the atmosphere that's going on. I think the answer is simple. Number one, you need to look at the people that are leading your troops in your organization for sales. And you need to ask yourself this question this year. Is this same leader going to be able to lead this troop across this field with these landmines as well as they could when they were leading during a non-wartime? Because the truth is, if your senior team has only been in place for 3 to 5 years and their job was to cash fat checks while they managed guys that serviced refis, and they're not showing you that they know the way or the direction, and they're not willing, this is what I would do as an SVP, because I've been one for 24 years before I retired to do this 5 years ago. I would tell you I would shake my boat. I would push till I pulled punches from my sales staff. And then when I pulled punches, if I had guys that quit, I would live with it. And I would say the rest of us need to have a higher commitment. Let's go. Because that's what it's going to take. You have to find the tenacity and loyalty of these sales troops. And then you've got to give them guns that are actually going to shoot this year. And so senior leaders are distracted trying to save their ships right now, and they may have the wrong sales leaders in place. They really need to lift their heads and ask what's going to convert. And if everybody's going to pray to just spend capital until the rate reduces, well, then you're going to be beholden to that type of loan officer for the rest of your career in this field. And that to me is sad. And I see that right now. I feel sad in that way.
Well, I can't believe there's this many branch managers nationwide. And you've talked about it before. It may be that we just need a changing of the guard at the retail branch manager level, if you're working retail, that is.
Yeah, and thank you, Christine. And we do have a replay of this on Sundays on YouTube. So we want to go over to Greg Harris. Well, do you want to say one quick plug for yourself or even?
No, I mean, everyone
Okay.
find me on LinkedIn. I love to talk to people. I'm passionate. As you hear me every single day, I come like this. These are the years I'm giving back to the industry. I wanted to add a different consulting and coaching firm to America. I came up through all those other coaches. They're all amazing. And I'm just one of the choices in the industry to help people do a better job with their sales force. So thanks for having me today. Stay strong out there. And thank you so much for giving me the platform to speak. I really appreciate you. I see you, Brian.
We loved it. Well, Greg, hearing all of that, as somebody that now not only runs a mortgage company, but talks to others as they're coming to you to buy leads. I mean, I don't think I really have to ask an opening question. Why don't I just say, do you have any comments on what you just heard? And then how does it relate to the platform, you're putting out or your vision for 2024?
Yeah, I appreciate you having me on and to be a part of this passionate conversation. I love Christine's passion. That's, I'm so passionate. I've been doing this for 27 years. I've been an originator, and I like to say my platform, Lender City, what we're launching is, built by an originator for originators. So my passion is connecting consumers, prospects, with as many mortgage companies of all sizes as I possibly can. And then from there, obviously, they've got to know how to talk to people. They've got to know how to close the lead. So it's, from nurture to conversion, all the things some of the things that Christine touched on as well, in terms of how to sell. And so, consumer direct is a little different than what a lot of people are used to. But, you can be trained to do, if you've never done consumer direct, you can be trained to do consumer direct. And I've got a direct D2CU, which is direct to consumer university. And I've basically bottled up all the things, call them tricks of the trade, but the things that work for me, they're not really tricks, per se, but email scripts and text scripts and best practices on when to contact a consumer when the lead comes over.
And those are primarily purchase, correct?
No, both purchase and refinance. I mean, this is we're a rate table, for lack of a better description. The difference between us and let's just use bank rate, for example, is the fact that this is, with bank rate or with a NerdWallet or Lending Tree is a little bit better. There's minimum monthly spends. You've got to be licensed in so many states. They're really after the deeper pockets. And my vision for this for years, and I've had this vision for, believe it or not, 20 years. And it's shocking that nobody has made this more available to smaller to medium-sized mortgage companies up until now, was to open it up where there's no minimum monthly spend. If you're a broker and you don't have the deep pockets and you want to hop on and pick up a lead here or there, so be it. If you can display on our in our rate marketplace and be seen by consumers that are shopping for a loan, then by all means you can be present. But it's open to both purchase and refinance.
What do you find is the difference in purchase, refinance, how quickly you get back to one of these leads? Which one is more sensitive to the faster you do, the more likely you are to close it?
I would say a refi lead is probably more sensitive to that. And to be honest with you, as I launch this, I'm still buying leads and I have a brokerage, an active brokerage. So, I'm in the trenches every day, seeing what originators see and feeling what originators feel. With a refi, obviously you're looking for the lowest rate. Otherwise it doesn't make any sense. With a purchase, you're looking for the lowest rate, but you're also looking for somebody who can get you the closing on time, painlessly, or as painless as possible. And so they're a little more methodical on a purchase, in terms of shopping and talking to different lenders. Of course, they've been referred by a realtor. They've probably been referred by a friend or family. And then they're out there kind of searching online. That's kind of the process. With a refinance, I would say most people are probably just hopping online looking for rates, and they're going to a bank rate. Hopefully they're going to Lender City, they're going to NerdWallet, and they're just searching for the lowest rate out there because it's a refi, right? I mean, it's the end of the day. It's like, what is my rate? What are my closing costs? And they know that time is of the essence to lock in. And so they want to find that rate. I had a guy email me, just closed in July, and he said, what's your rate on a 30-15? I threw out both rates, and he goes, lock in the 15. Boom, done. He knew it was a point lower, and he's like, I'm ready to go.
And that's really cool. I mean, that's pretty much what I do all day. No, I'm just kidding. That's obviously ideal results. As far as purchases go, and Christine mentioned like helping out real estate agents. How many people, when you're dealing with an online lead looking for rates, selling their existing home and trying to buy a new one versus don't currently renting and don't have a home and they just need a pre-qual on their new home? Like, do you find that a lot of these people are trying to get qualified before they list their home, or is the listing opportunity long gone?
We do a lot of pre-approvals, as a broker. I'll just talk to you, from the broker standpoint. We do a lot of pre-approvals. And I will say that I am seeing, probably because they have such a great rate on their existing home, I'm seeing more people retain a home, or at least try to retain a home and rent it out, or decide what they're going to do after they close on a new home, than ever before. I would say it used to be, prior to the pandemic, most people were selling their home either prior to closing, concurrently, or just shortly thereafter. And now most people are like, yeah, I'm like, what are you doing with your existing home? We're going to retain that. So, whether or not they sell it after the fact, maybe they want to fix it up. I don't know if that answers your question, but, a lot of these come in as pre-approvals.
I love that you say that. I mean, it's much to the dismay to the originator that they want to keep it. But I really believe that the environment that we're in right now, it's those who have will continue to have, and those who don't may be out of it if they don't take immediate action. And so I like that there's a greater opportunity to keep property, not because of the lower interest rate, but because values have been increasing over a longer period of time. So Greg, what do you think can be done by servicers of mortgage company, for example, like a Mr. Cooper or a Wells Fargo or a Bank of America? Because you're going to be competing. If you're an originator, you may be competing against the servicing company when they go and quote unquote back solicit that customer again. What are you doing to combat against that type of tactic? Because it's going to be coming very quickly in the next year.
You mean in terms of like a refinance, let's say?
Yeah, and well, either refinance or sale, because I think that if there's going to be a payoff that's being ordered, more than likely the homeowner is going to be selling their property. So, hey, escrow just ordered a payoff. Can I, we're a Mr. Cooper, we're a Wells, we're a B of A or some other direct IMB or bank. So what, they say, hey, we'll close. We already have your documentation and we can close this in 2 weeks. I know you only have a week left in your escrow, but we'll get it done. So what do you think is being done to provide more value, or is it a value proposition? Is it a relationship proposition? And what kind of advice do you give to an originator or to your sales staff?
I mean, in terms of being able to, and you're talking about if somebody's under contract, let's say, and they're looking to close within a couple of weeks, correct?
Yes.
Just to make sure I follow you.
Yes.
I get that all the time, and it's kind of crazy because we're back to a point. I guess it's because technology and people expect you to close quicker. But I'm seeing more 2 and 3 week closings than I care to admit.
Wow.
Than I care to deal with, to be honest with you. But we what are you going to do? I mean, that's business, and that's what you've got to deal with. For me as a broker, I've got 35 different lenders that I work with, wholesale lenders that I work with. Of that, there's a handful that I would trust to get me across the finish line to that closing on time. And so I think it's super important that you choose your partners wisely. And for me, the value proposition is, I sell rate, and then of course I sell value on top of that. Why are you coming to me as a broker? Because I've got a lower rate than, probably 3/8 to a half a point lower than my competitor. And that's the feedback I get from prospects when they're like, what's the catch? What am I missing? How are you doing that rate with 0 points, a zero lender fee? And I'm like, because, we're a smaller broker. We work with 35 different wholesale lenders. I run it through a pricing engine. It comes back, it tells me the best deal out there. But I can guarantee that I'm going to get you to closing. And my goal is always a clear to close at least a week prior to closing. Which, if somebody's coming to me closing in 2 weeks, that means I got to get a CTC in my mind in a week, which is a lot of pressure. But we make sure that we coach the consumer and let them know what they've got to do in order to get there. So you're going to apply. We're going to get your rate locked. You're going to sign the disclosures. You're going to upload your documentation. We're going to submit to underwriting. We're going to review all that, of course. And then we're going to submit to underwriting. And then any follow-on documents that are needed, I need those ASAP, like the same day I request them. Otherwise, we can't close on time.
I mean, that's the scene out there, right? And I think to kind of bring everything full circle here with what we've been talking about, there's going to be different pockets. And obviously the broker is gaining more market share because they're local. And people buy from faces more than they buy from brands. They buy from people. And that's why these lenders, grow. And then at some point they can be outflanked by better pricing, especially when Christine talks about it. If your management, rather than teaching you ways to combat low pricing with better value offer on some financial advice, at a scalable model, hundreds of loan officers have to learn it and believe in it. If that middle management is stuck right now, as far as was able to just be more coaching on filling the abundancy model, then that's more advantage to the broker right now until the market reshifts or the employees reshift, etc. Overall, I think everybody is optimistic about next year. Thank you, Greg, for coming on. I know you're a frequent guest of the show and you'll be up here more often. And if you guys haven't checked out his platform, please do. I think he's raffling off some free leads, or he was, or if he's not, come on our next show and do it. But thank you, Greg.
Yeah, appreciate your time and having me on. Still giving away leads as we pilot this. So we are actively signing up mortgage companies, and just reach out to me for more information. Be happy to provide it.
That's awesome.
Thank you very much. And so next week, Michael, I don't know if you know this, but I saw somebody posted a very high up at one of the banks in mortgage posted that he volunteered to hold the bell, it's called. So the Salvation Army bell. And I thought it was a really cool story. And I said, we'd be on our show next week. So he's going to be on and I think if we can get some other holiday stories from leaders around the industry. I was looking at Chris Avery always does a great post where the night before Christmas to relevant topics in the mortgage industry. So maybe I can get him to come on, tell us how that happened, that came about. I went to an event down for Alcova Mortgage in 2015, and we stayed at the Jefferson Hotel. So I'm going to see if Bobby Nicely can come on there and talk about how Alcova goes there and what the Jefferson Hotel means. But anybody in the audience, if you can hashtag MoreTalk in a comment of a post you see where you think I should reach out and see if they want to come on, just anything that really makes your heart warm up. You guys know the part of the Grinch where the heart grows 3 sizes because of Mary Lou Who and the fact that she wants to give, she doesn't want a present this year. She just wants, her mother to have a break, and that helps the Grinch's heart grow. Anything that makes you feel like that, give a hashtag, and we'll invite them on the show and have them tell their story. Thank you, Dee, for the reaction. We do this for reactions. We appreciate it. Remember, this is available on Sundays. Remember, Adopt the Brand helps the right. Basically, we match vendors and lenders where we think it's a perfect fit, and it's quite often some forward-thinking technology that's not really out there. You don't know about it, kind of like what my friend Holt's doing there in the audience. Anything else, Michael? I know we got the holiday season. I'm looking forward to the next week. I think we'll have some fun music and just have a great show and try and make everybody feel warm and hearty.
I feel like Chairman Powell became Mary Lou Who, providing us with a bigger heart, telling us that we're going to have lower rates next year to the entire real estate industry. It was not only warming the hearts of Wall Street, it was also warming the pipelines of future business for everybody in the mortgage and real estate industry.
And if you're in the industry and you're probably listening to this show, watching it, warm the feeds of our LinkedIn, right? Ho, ho, ho.
That's awesome, Michael. I'm excited for not only the year to come for the next few weeks. I've got a few sales and closings for our team that we're super excited about. So this is
mention that real quick for the people listening. What we're looking for.
In which part? I know that
anything you're closing, anything you're looking for in the new year for business.
For the sales team, they're closing about $8 million of bridge funding business that I've been able to raise the capital for, and then selling it off for the family office. And so we're definitely have some performance on the family office, selling off that money, and then the origination of $8 million of business is pretty exciting for the team, right? So I think that we're already looking forward to that. And then the fact that with rates coming down, that's just going to add to our pipeline. So I'm super excited about that in the fact that we're going to be generating that. And then we've been in buying mode in the actual mortgages. And then knowing that as rates come down, those are going to become more valuable so we can sell at a profit. So all of the above is super exciting for me. And on the recommendation of Rob Chrisman, there's a book that I just purchased that I'm super excited to read when it comes to capital markets as well. So I'm looking forward to reading quite a bit and maybe even listening to a few more podcasts, but reading a few books is something I'm looking forward to this holiday season.
Well, thank you, Michael. That's what we're all about. If you guys can help us in the audience, please tell us about a deal. Tell us about a story. We'll see you guys next Thursday at 2 p.m. Eastern, 11 a.m. Pacific time. This is More Talk with Michael and Michael. Thanks for hanging out.